In this video, we're going to go over one of the things that most Canadians want to know, which is the financing. How do we actually get a financing as a Canadian without any US credit going to the States? So this is a very, very interesting topic because if you think about it, in Canada, we have like about 60, 70 lenders. But in the States, there's over 5,000 lenders that can be working with us. So there's a lot more loan products. There's a lot more financing options out there. But the biggest issue is that how do you actually break into the market without the US credit? So the keyword here is called DSCR, Debt Service Coverage Ratio. And this type of loan product is very, very common in anything about 5 units, 6 units, even in Canada. Okay, this is more like a commercial loan. In the States, you can definitely use DSCR in residential properties or residential portfolio. The main thing about DSCR is that it's going to look at how much income that can be generated from the property versus how much of the expense that you're going to have for the property. So without looking at your personal income, the lender is willing to just look at your property, calculate the numbers, and make sure that the risk is covered. And from there, they're willing to release the DSCR loan to you. Okay, so there's a couple of things that we need to keep in mind. Number one is that the interest rate typically is a little bit higher. In 2025, there's a lot of things that we're looking at. Number fluctuates depending on the market, but in today's market, we're looking at roughly 8%. Sometimes you will get about 6 or 7%. Sometimes, depending on the situation, the neighborhood, you might be looking at maybe 9 to 10%. So 8% is the most common rate that we're seeing when Canadian pivoting to the States without any credit. Okay, so I'm going to use 8%, 30 years, okay? And the most important thing here is the loan. So highly depending on what type of properties you're getting. In this case, I'm going to use a very, very simple example. Let's use like 150K as a loan amount. So you might be looking for a duplex, 200K in B-class neighborhood, and you're trying to like really give that value add approach, and you're going to renovate the property, bring up the equity a little bit, and try to aim for that ARV to be 250K. 150K is what we're going to put in here. Loan amount per month is going to be 1,100. So NOI stands for net operating income. What that means is that you're going to take the total rent minus the total property spending expenses, such as tax, maintenance, insurance, utilities, vacancy rate, property management fees, and all that stuff. Once you combine everything all together, the leftover without the mortgage payment is what we call net operating income. That's the term that we're going to be using a lot in this process. If I'm looking at this duplex and the duplex is doing, let's say the rent amount is 1,200 per unit, so you do 1,200 times 2, 2,400 minus the tax, maintenance, insurance, which in reality, we've seen so many different cases like this. Roughly, you're looking at about 1,100. 2,400 minus 1,100, this will give us about 1,300 per month. Now, if you look at the DSCR right here, it's not over 1.25. 1.25 is what we're trying to like figure out. So in this case, there's a couple of things we can do. Number one is that maybe we're running the number a little bit too conservative. Maybe each unit is 1,250 or 1,300. Or option two is that you just need to improve the property standard so that you can actually rent it to the market for 1,300. The moment that you're doing 1,300 times 1,300, that's 2,600 minus the 1,100 here, which is 2,600, which is 1,500. Now we're over 1.25. Then this property has a proper exit strategy for DSCR. Now we're over 1.25, and this tells us that the lender will be able to actually lend you the funds based on the number that we're looking at right now. That kind of sums up how this DSCR works. And by the way, another option that you can also consider if you're finding it's really hard to actually make that 1.25 work with the comparables, one other thing that you can really consider is also reduce your loan amount. Put them a little bit more for the down payment, and that can easily solve the financing problems. And that's it. This is basically how the DSCR loan product works. You might be using this for the first like 2-3 times, and then after that, with a little bit more of a US credit, US history, transaction history, you will be able to kind of unlock different options in the States.